So in Chapter 6, we go full bore into the concept of elasticity. And just something to keep in mind, when we talk about elasticity, what we're really talking about is sensitivity. Sensitivity specifically in terms of prices. There are other sensitivities, but the price is the one that's most common that we'll start getting into when we talk about price elasticity of demand. So how sensitive that demand is to a change in prices, or a change in the change in anyways. You got the idea. So we'll move on with elasticity. So again, first we're looking at price elasticity of demand, which we kind of talked about somewhat before. But again, the equation that's associated with this price elasticity of demand is the change in quantity, demanded. The percentage change in quantity demanded is really what we're saying, over the percentage change in the price. So it's the sensitivity again. That quantity demanded to the price changes, price level changes. So that's the relationship we're looking at. We're looking at the relationship between, again, the quantity demanded and the prices, the changes in quantity demanded over the change in prices. So the first graph that we're looking at is when we're looking at price elasticity of demand is, looking at a typical demand curve sloping downward to the right, price on the y-axis, the vertical axis, and quantity being on the x-axis or the horizontal axis down below, and the demand curve sloping downward to the right. The midpoint, as noted, going bisecting that demand curve, is called the unitary elastic point or unit elastic. At any rate, that's the midpoint of that demand curve, and the lower portion of that demand curve, but not below the unit elastic point or unitary elastic point, is called the inelastic range, and the upper portion is called the elastic range. So what that means is that if you are in the inelastic range and you want to increase revenue, we're all about, put our entrepreneur hats on, we're all about increasing our revenue. What we do is we can raise prices. And again, as we showed before with that marginal revenue curve down below, if we're in the inelastic range and we raise prices and remain in the inelastic range, we're not going past the unitary elastic point, then the price increases, even though law of demand dictates that quantity demanded is reduced. That price increase will result in increased revenue. If, however, we're in the elastic range, past that midpoint, past the unit elastic point, moving up the demand curve toward the price line or the y-axis, if we raise prices in the elastic range, then what happens is that we're coming down the other side of that marginal revenue curve, and we end up doing what? Losing revenue. So price increases in the elastic range are not revenue enhancing. Whereas if you do increase prices and remain in the inelastic range, then that would result in increased revenue. Likewise, or conversely, I should say, if we're in the elastic range and we reduce prices, what we find is that we actually increase revenue. And if we're in the inelastic range and we reduce prices, we actually do what? We end up losing revenue. So again, when we're talking about, on the right-hand side, we're looking at price elasticity, movement along the demand curve itself. In this case, we've already walked through it, that midpoint, the unitary elastic point, so on and so forth. So what we're looking at here is a shift in demand in the lower right-hand side. And what that shift in demand, what happens is that if you were to, in this case, we're flattening the demand curve, moving from the steeper demand curve on the left to the flatter demand curve on the right. Nothing has changed. Price remains the same. The only thing that's happened is the demand curve has shifted. And in this case, what happens is that shift in demand causes us to move from that unitary elastic point, that point where we're maximizing revenue, we moved into the elastic range. Again, no action on individual firms' part. It's just that the demand curve flattened, perhaps due to increased competition, more competitors entering the market, increase in the number of firms in the market. Okay, so again, if a shifting demand curve will result in movement so far as that if the price level does not change, shifting the demand curve will change the position where a firm is at so far as its range in terms of being in the inelastic range or in the elastic range. Okay, so conversely, what would happen then is that we have a flattened demand curve. We end up at moved into the elastic range. If we had a steeper demand curve, the demand curve actually steepened, that would probably move us into the inelastic range, or would have moved us into the inelastic range. Or if we shifted the demand curve a parallel shift outward, that would also alter where we would be at so far as the price elasticity is concerned. So again, on the left-hand side, we're looking at our demand curve with that unitary, where we're at so far as the on the demand curve, and the relationship with the total revenue curve placed directly below it. So if we're in the inelastic range, on the lower half of the demand curve, below that midpoint, below that unitary elastic point. I've got equilibrium price on here, but that's really supposed to be the midpoint or the unitary elastic point. So if we're to the right of that, we are in the inelastic range. And as a result of which, if we increase prices in the inelastic range and remain in the inelastic range, or perhaps moving to that midpoint, that's going to result in increased revenues. Again, above that midpoint, that moves us into the elastic range. And so if we increase prices, say moving from the unitary elastic point, where it's at $2 per, move to $3, what's going to happen is that we're going to end up with what? Less revenue. Anyway, moving over to the right, we're looking at just in terms of marginal revenue. Remember, marginal revenue is 1/2 of that average revenue curve. So it's the halfway point between the average revenue curve and the y-axis. So anyway, marginal revenue, or the reason why price cuts in the inelastic range are not effective. Marginal revenue is the incremental revenue as the quantity sold changes by 1 unit. Remember, marginal always refers to change by 1 unit. So moving from $3 to $2, moving from $3 to $2, total revenue actually increases from $3 up to $4. So 3 times 1 quantity demanded, moving to $2, 2 times 2 quantity demanded results in $4. At $3, total revenue is equal to price times quantity, the quantity sold, the demanded, etc. The total revenue is equal to $3 times one quantity of 1. Total revenue is equal to 3. Marginal revenue is equal to $1 at $2. Total revenue, price times quantity, sold, the portion sold or demanded. Total revenue is equal to 2 times 2. Total revenue is equal to $4. Marginal revenue is equal to 0. So this again depicts what we're talking about when we're looking at that marginal revenue, and shows the relationship with that the total revenue curve. We're adding to this 1 unit, what 1 unit change will result in. So again, when we're looking at price elasticity of demand in particular, we're talking about we have already kind of somewhat discussed it with the flattening demand curve or the steepening demand curve, how that impacts the elasticity. The flatter the demand curve, the more elastic. Okay, in general, we're saying what that means is that the more sensitive it is to price level changes, meaning that if you increase prices with the flatter demand curve in this case, moving from D1 to D2, the flatter demand curve, a price increase, price level change is going to have a much more dramatic effect in terms of the quantity demanded. It should be pretty straightforward. So further, when we're talking about this shift in demand, is something I again spoke to before briefly, and that is that, say we're looking at a parallel shift on the demand curve, moving from D1 to D2 in this case. So we had our original midpoint, our original unitary elastic point at a certain price. But if we shift that demand curve, we increase demand. Remember, moving to the right is an increase in demand. So we're increasing demand moving from D1 to D2. We end up with a new midpoint at a higher price. So what that means is that our elasticity has changed as well. Say, for example, we were at the old midpoint price, at that price at the old midpoint, price did not change, then that would push us in the new demand curve, or the shifted demand curve, into the inelastic range, which of course means that if we wanted to increase revenue, or we could increase revenue by doing what? By increasing prices. Okay, so this is the impact, if you will, of shifting demand curves. And oh, by the way, again, these demand curves are shifting all the time. It's so nice to be able to look at just a straight line demand curve, but they come in all shapes and sizes, curvilinear, with curves, with straight line, with kinks in them, so on and so forth. But for our purposes, we're just looking at a demand curve that looks pretty straightforward so that we can gain an understanding, or at least a basic understanding of these topics. So again, price elasticity of demand: when demand shifts, when the demand increases, more or less a parallel shift. Price elasticity, demand decreases, and price increases in their range are more revenue enhancing. So again, we spoke to, again, with the price elasticity of demand. Now, we're looking at a different situation now. Rather than flattening demand curve, we're looking at a steepening demand curve. And the reason we want a steeper demand curve, or what happens when we have a steeper demand curve, it becomes less sensitive to price level changes, because the steeper demand curve, raising prices relative to that flatter demand curve, there's less of an impact so far as that quantity demanded is concerned. Okay, so this is the goal, by the way, of advertising. So that marketing or advertising goal again is to reduce or dampen the substitution effect. It's trying to differentiate your product from the other, make your product more unique, so that if you do have a price increase, it may be more difficult for you to substitute some other product for this product that we're looking at here. And the way you arrive at that, again, is through advertising, and advertising comes in many different forms. In probably its purest form, advertising would be to explain, the actual characteristics of the product that you are producing and how it differs, how it's better than some other product. But the reality is that advertising is, it's most of the time, it doesn't stick to that type of a guideline. It has more to do with how many commercials you can produce, and how widespread, how much you can saturate the market with your own advertising versus your competitors. Anyway, you get the idea. The takeaway from this is that with price elasticity of demand, if we have these steeper prices, and this is the goal of advertising, marketing, etc., is to make it less sensitive to those price level changes, meaning that you're able to do what? Raise prices without reducing your revenue. Okay, so price increases would be revenue enhancing, meaning that you are in the inelastic range. Anyway, other types of elasticity that we'll briefly kind of go over. One would be like income elasticity, where we have more income allows you to buy more normal goods. So that would that should be pretty straightforward. The connection, if you will, between income and your ability to buy more things, right? Cross price elasticity is something that we use to determine a market, whether or not they are substitutes, one for another. So an example of that would be light vehicles. The light vehicle market includes cars, SUVs, crossovers, and pickup trucks. That is what constitutes that market. Meaning, well, let's just say, for example, anyways, it's the takeaway from this is cross price elasticity is actually determining the market itself. And again, when we say light vehicles, this is contrasting with heavy vehicles, which would be commercial vehicles. Vehicles that are not for regular drivers, if you will. And so this does change, but again, this is where we determine the cross price elasticity. This is what the utility of it is, that concept. So again, anyway, FYI here, non-passenger cars amount for around 70% of the market of new cars, meaning SUVs and pickup trucks account for a significant, or 70% of the of that car market. So it's no longer just passenger cars, sedans, and so on and so forth, right? So again, we're trying to find out what goods are competing to determine what that market is. So here's the example, Alcoa. So Alcoa is an aluminum company. It's American aluminum. It's an aluminum company of America. Alcoa, the aluminum co, the company, and the A is America. So aluminum company of America. They make like aluminum foil, for example. Okay, and so this would have been, not sure, just guessing, back in the 1960s. They had about 80% market of the aluminum foil market. The others would be such things as like Reynolds wrap, so on and so forth. So what happened was the FTC and the Department of Justice got after them, and they said, oh, you constitute too large of a portion of the market. You are a monopoly, in effect. So they wanted to break up Alcoa. And so Alcoa's response was, using this cross-price elasticity notion, this idea. They said, well, wait a minute. Now, yes, we have 80% of the aluminum foil market, but in determining what the market was, they said, no, aluminum foil is not the market. The actual market is total food wraps. So all food wraps would be included in that market. And by the way, they did win the argument. Point is that they're saying that it wasn't just aluminum foil, it was also things like, the plastic wraps, like saran wrap, wax paper, which it was losing favor, and of course it's back in favor now because of using it for microwaves, etc. But anyway, you get the idea. This is what the basis of cross-price elasticity is, to determine what a market is, what is a substitute, what can be substituted one for another. The takeaway was that Alcoa, while it had 80% of the aluminum foil portion of the market, overall it was much, much smaller because of such things as the plastic wraps, the saran wraps, Ziploc bags, different, probably going as far as actual food containers. It was this, so they changed kind of the rules, and they won based on that. They being Alcoa, did not have to break up their company. There are other types of elasticity, such as like tax elasticities, demographic elasticities. It's all about sensitivity to prices, right? Is really what it comes down to. So two things. One, with tax elasticity, what that means is that, say for example, you have a cigarette tax, and the cigarette tax in Michigan is pretty high. And if it's high enough to make sense for people to, so in theory, the idea behind taxing cigarettes is they're so-called sin taxes, like on liquor and cigarette taxes, and I'm sure there's some others out there as well. But the idea is that tax the cigarettes, and people are supposed to law demand. The price goes up, the quantity demand is reduced. The reality is, it's a revenue maker. It's a revenue machine for government. Government does not want everyone to quit smoking. Government wants to what? To increase its revenue. So these tax elasticities are very carefully looked at by government, because you don't want those unintended consequences where you raise prices and you are in the elastic range, and that price increase that results in fewer taxes collected, right? So that's tax elasticity. Demographic elasticity would be having to do with ages. Some old people like me have different desires and so on and so forth than younger people. So we have different elasticities. Last question, what impact does time have on elasticity? Very, very important point. Time tends to make things more elastic. We'll just say that point blank. Example, before, say, around 2008, there was not a very good substitute for crude oil or for natural gas for that matter. And oh, by the way, there still isn't. And even though we're moving more toward renewables and so on and so forth, more of the green stuff, the green energy stuff, the reality is that fossil fuels are still with us and will be for some time to come. What I mean by this is that time component was that, yes, we still have crude oil, we still have natural gas, but what happened in 2008-ish, that time frame, and moving forward, we started to be able to we've increased the supply of crude oil and certainly natural gas, both, to the point where, at least in theory, we as a nation, the U.S., is energy independent. It's kind of come and gone a bit, but we're in, at least we are able to be energy independent, and a large role to be played in that was this bringing fracking on board, which, by the way, had been around for 70, 80 years, but that's neither here nor there. It was not really pushed until around 2008. So the time, meaning there's not a really good substitute for crude oil. There's not a really good substitute for natural gas, but that actual production, we were able to make the changes, and so that had a definite impact on the elasticity. And in particular, the prices came down. I know they go up and down depending upon for a variety of reasons, but the reality is that fracking has enabled us to increase our ability to extract that crude oil and natural gas. Anyway, that's the time component. Time can heal many wounds so far as elasticities are concerned. Okay, so again, we've already talked about the time component of elasticities. Now we're going to be moving into, kind of jumping into the next portion when we start talking about cost of production, business cost of production. It's actually the next chapter that we're going into, but this is kind of a brief overview, if you will, discussing the background. And so we're starting with the concept of diminishing returns. Diminishing returns are pretty straightforward. There are diminishing returns. If you put more effort into something, you may move closer to that point, but the returns are perhaps less visible. Example, you go on a diet and you're trying to lose weight. In the beginning, what you may find is that you're losing a lot of weight very quickly, and the more you continue on the diet, assuming you continue with the diet, that weight loss starts to drop as you continue on. There are diminishing returns. You're experiencing diminishing returns. Anyway, in the short run, increased production puts pressures on our productive resources. This is scarcity. This is when we talk about supply, why the supply curve slopes upward to the right. Increased production puts pressure on our productive resources because all resources are scarce, right? There's scarcity involved. Variable inputs, costs such as labor and other inputs, they do vary with the production level, whereas fixed costs like plant and equipment, they don't change, or they're for the most part fixed. Those are the two components. The variable cost, the more you're producing, the more that you're using labor, for example. And fixed cost, regardless, again, in the short run, regardless of how much you're producing in that facility, the cost perhaps of the facility itself, the rent or the leasing or whatnot, that fixed expense associated with that, the equipment that you have that you're employing, the current technology that's not changing. So the variable changes with increased production as production increases, and the fixed costs do not. So upward sloping supply curve, again, this is the background of that, or how to deal with diminishing returns in the long run. So we have to expand production capabilities. This is altering our fixed cost, if you will. But anyway, so diminishing returns can be offset again in the long run by making more efficient, adding more resources, improving those resources, education, and most commonly by technology, adding technology. And a little reminder here to think about the PPC. How do you push the production possibility curve out? You push that out by, or most frequently by adding technology, and the reason we add technology is just that. We become more efficient. We're able to push our production possibility curve out. And so that's moving from the short run to the long run is by adding more fixed cost, to be blunt about it, be straightforward. So again, diminishing returns, rising opportunity cost is what we're talking about. There's rising opportunity cost that's involved with whatever we're doing. So if we're looking at our total variable cost, the cost again that increase with production versus fixed cost, they remain the same. If we look at it in terms of this relationship, cost on the y-axis, the vertical axis, and goods produced on the x-axis or the horizontal axis, fixed costs remain the same. They are fixed, whereas variable costs rise as we're producing more. And you'll notice that the curve is getting more vertical as we go, again reflecting that opportunity cost that we just mentioned. So we were just talking in the previous. We were talking about the total fixed cost, the total variable cost. Total fixed cost doesn't change. Variable fixed cost, total variable fixed cost rises with more production. And this is as opposed to average fixed cost. Remember, average, we're spreading our cost over the number of units that are actually produced. So with the fixed cost, what happens is the average fixed cost, what you'll notice is it slopes downward and it becomes pretty much, the term is called asymptotic, where it approaches the horizontal or the x-axis or zero, really, so far as the costs are concerned, because you're producing more units and you're spreading that cost over more units. And it approaches, it doesn't get to zero, but it gets darn close to zero. Because again, this is the fixed cost. It's not changing. The more units you're producing, that the average fixed cost again approaches zero, moves closer, ever closer to zero. Now on the variable cost, what's interesting is that initially at the very least, they go down. This is like a U-shaped curve, this cost curve. So the average variable cost slopes downward. You're producing more goods, and it slopes downward. Why is that the case? Then it flattens out, then it starts to climb. It is because if you think about it, put it in context of like a real situation. So a real situation might be like a restaurant, okay? So you have a restaurant and you've got all your fixed costs and your equipment in the kitchen, your stoves, your ovens and fryers or whatnot, and all this stuff that you've got there that you've loaded up all your fixed costs, and you start to produce things. You start to the restaurant starts to fill up, starts to get more people, and as it gets more people, you need more what? You need more wait staff, more kitchen help, so on and so forth. And initially, as you bring people in, your costs are going down because you're doing what? You're producing more meals. You're selling more food. You're moving more customers through the store. The takeaway is that this goes on, and we've all seen this. You're moving into the rush hour, and you reach the point where if the restaurant is popular, it becomes very, 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 very full. And you reach the point of diminishing returns because you can only fit so many people into this establishment at one time, not just customers, but your employees as well. There's only so many people that, there are only so many meals that can be put together in the kitchen, so many meals that can be delivered by the wait staff, so many meals, so much time associated with cleaning up the table after the patron moves on and more new patrons start to come in. So this is why initially the costs go down, the average variable costs go down until they reach the bottom, and then they start to rise. And it's not to say that we stop at the bottom. You continue on with your cost, because you want to do what? You want to take care of your customers. And even though it becomes more costly, the average costs start to rise. It's not that you don't really stop at the bottom. You continue on moving back up that average cost curve, the U-shaped average cost curve up the other side. Okay, that's it for now.